Well, hello. Today is July 26th, 2017. Again, here I am in wonderful, gorgeous, sunny Scottsdale, Arizona. A couple things I want to talk to you about. I just had a friend of mine talk to me about retiring, and one of his great concerns was income. Where is he going to get the income? You know, they're starting to do their calculations, and of course, I'm going to tell you that 65% of Americans are counting on Social Security as their means of having income to pay all the local bills. So keep in mind that you need income. You have to pay the electric bill. You have to pay the water bill. You know, you have to buy groceries. And quite honestly, we all want shirts and ties and new dresses, and we want to go places. The car breaks down. We need new tires. We need new brakes. We need batteries. You know, every once in a while we need a new car. So we have to have this income to pay for all these things. So regardless, they can say, I've got all this equity, I own farmland and oil land or ranch land, whatever it is. It's the income that's derived off whatever asset that you have is what works for you. So let's just review a couple things. If you're in the S&P, you're getting less than 2% on the dividends. Now, you could get 3 if you want to boost that up just a little bit more. Here's the concern, is a lot of these dividends are the companies like Exxon and Verizon. They're actually going out and borrowing money to pay the dividends. So they're going deeply into debt to keep paying the dividend. It's not from earnings. So when you look at all these PEs that are this high, it's the fact that we have PE expansion, not necessarily earnings in the stock market. And if you start looking at bonds, well, goodness, you know, the average, if you ladder out some bonds for the federal some treasuries, you're going to look at under 2%, 1.6, 1.9%. And if you want to take some risk, and this is where the problem is a lot of the risk has gone over into the high yield. And high yield is going to act just like an equity. It's correlated to into the S&P. So, you know, my concern is that we've reached these high levels of equity prices. We're at a PE ratio of over 30, and it's getting risk. So where do you go to get return and get a monthly conservative, consistent income? I've been pounding the table for the last 2 or 3 years that we need asset allocation. And when you retire, you need income coming in each and every month. You need consistent monthly income. And if you're going to transfer your allocation from one asset class to another asset class, you need to have immediate cash flow. So let me tell you, that's what we do. I mean, we're experts at that. We're here in Maricopa County. I headquarter in Scottsdale, probably one of the premier communities in the world. We're sitting right next to Phoenix, which is right by Peoria and Glendale and Chandler, Gilbert. These are phenomenal areas. And Maricopa County is the #1 growth county in America. And it's forecast to be the #1 county in America for the next 10 years. So if we slide to #2, we're still in good shape. So last year, I keep pounding the table. We got 85,000 net population last year. We're getting 222 people net a day moving here. It's putting pressure on our rentals. So you can come here and reallocate funds, and we're going to look at an immediate cash flow of 5 to 6%. And that's going to be on a piece of property. Now, we are extremely conservative at the moment. We're not buying big boxes. We're not buying malls. We're not buying land. We're not buying office buildings. We're buying entry-level, single-family homes that everybody in America can afford. And these homes go into your name. You hold them any way that you'd like to hold them. They're yours. They aren't entitled to anybody else but you. And we have management companies that do all this for you. They'll find a tenant. They'll take care of absolutely everything for you. If there's any work that needs to be done, they'll take care of it for you. So this is an immediate cash flow. So we can put you into a property, and the property can immediately start paying cash flow the moment that you get it. Now, here's the difference. There's some annuities. We touched on this just the other day. Some annuities are crowing that they get 8%. That's 8% with some of the principal being paid back. So just when you do a Bengen rules for when you call Schwab or you call Fidelity or you call whoever's holding your money, and you say I want to retire, they're going to take your nest egg and they're going to give you 4 to 4.5% fixed for the rest of your life, and that's going to deplete your nest egg. So by the end of 30 years, you're going to have a little bit left over. So in case you go 33 or 34, you're going to have a couple of bucks left. It's guaranteed to do that, but it's only 4.5%, and you're depleting your capital. So there won't be any legacy. There won't be anything left over for your kids. So if you buy a piece of property here in Phoenix, we can put tenants in it, and immediately you're going to get 4 or 5%, 6% in the way of cash flow each and every month net. That's after all the taxes are paid. That's after the homeowner association has been paid. That's after the insurance has been paid. That's after we put in a fund for, we call it a sinking fund, because things are going to break. We're going to need new dishwashers and garbage disposals. So we put an actuarial accounting for that, and we pay for management out of that. We pay for vacancy factor out of that, and we pay for cost of leasing it, because we're going to probably have to pay someone to lease your property for you. So all those costs are put in there. So it's a net figure. It's just in a gross figure, and that's typically between 5 and 6%. First year. So those people last year that took 5 or 6%, we raised rents. We have raised rents consistently for 30 years here. So now you're going to say, oh, well, we had the 2008, 2009 debacle. We did. But what happened was that rents went down and taxes went down, insurance went down, the maintenance factor went down, the vacancy factor went down. So it almost netted itself out just about free. So here's what's going on is that last year we raised rates. So those people are paying 5 or 6%, they're getting almost 9% return on their money. And people that bought 2 years ago, they're over 12%. So we're growing that income for them. So their monthly, consistent monthly income is actually more and more and more and more. They keep growing this income. And guess what happens? We're not depleting their nest egg. So you've got an asset that's growing. So we don't really care too terribly much what happens once we buy it, once we own the property. We're kind of like farmers. We own the land. We're never going to sell it because we're going to give it to our kids or to our generations behind us. So, but we're very concerned about the crops. So what we have is a crop. We have rental income coming off, and that's what we're concerned about. So not that we want to buy into an asset that's going to lose money on, but our focus is not on the asset price itself. Unlike stocks, where you have to worry about them going up and down all the time, we're actually worried about the assets, what is actually use factor to us, and we're actually able to receive off it as a net. And you should, the very first year, get 5 or 6%. Now, if you're retiring, this is wonderful news for you. You've got income coming in. Where are you going to go to get this? Where can you go to get this kind of income that's going to grow for you? And here again, had you bought 2 years ago, you'd be getting almost 12% back on your cash on cash return. So it's been very, very significant. And quite honestly, the asset, I tell you, we don't focus on it, but the asset has actually gone up too. So we've had ridiculous total returns. I will tell you, I did one for one of my pension funds in 2016. We returned 44% total return on that, and it cash flowed 5 to 6% each and every month. So and keep this in mind. If you're a small investor, odds are really, really good, that the income that you receive off your rentals will be tax-free, because you'll be able to depreciate. Now, you need to talk to your accountant on it, because not everybody qualifies. You make too much money, it doesn't qualify. But if you make under $100,000 net on your taxes, you're going to have yourself a nice little shelter for yourself. So it's very possible that you get this 5 or 6% tax-free. So how would you like to get like a municipal bond that's much safer than any other investment that you have, and it grows, and it's tax-free? What a great, great deal. So here we are in Phoenix, and the number one city in America for growth. The jobs are phenomenal here. We're the number one job creator in the country. So it's really, really, really a very good market, and we're just in the beginning stages of it. So I'm looking for 2023, 2024 before we even have to worry about what we're going to do with the portfolio. So think about this. Talk to your significant other. Talk to your financial planner. Talk to whoever it is that you talk to, your attorney, talk to your estate planner, and see if this isn't going to work for you. And we will work hand in hand with everybody, everything that you do, everybody that's important to you, and we will do the right thing for you at all times. I'm a fiduciary. I will take care of whatever it is. I've been in, both my boys are Eagle Scouts. We're big Boy Scouts, so we know what it's like to do the right thing.